Somewhere right now, someone is sitting in a dealership under fluorescent lights, staring at a number on a window sticker and trying to decide if they can afford it. They are asking the wrong question. The sticker price tells you almost nothing about what that car will actually cost you. The people who know that are the ones making money off the people who do not. A few years ago, a buyer in California signed paperwork on a $30,000 SUV. She felt good about it because the monthly payment fit her budget and the salesman was friendly. She drove home in a new car, then in a grocery store parking lot, she pulled up the Edmunds total cost of ownership calculator and typed in her car. The number that came back was $55,000. That was the real 5-year cost. It included loan interest, insurance, fuel, maintenance, and the value the car would lose every month she owned it. She cried in that parking lot because nobody had ever told her to ask the right question before she signed. The right question is not what this car costs. It is what this car costs per year you own it. That one change in framing changes every decision you make about a vehicle. It is the difference between the buyer who walks out ahead and the buyer who is still paying for a car that broke down 2 years ago. Everything in this video builds toward that number. Once you know how to calculate it, you are playing a completely different game than almost everyone else in the showroom. To understand why that number matters so much, look at one shape. Economists call it the depreciation curve, and it looks roughly like the letter U. The moment a new car leaves the lot, it starts losing value fast. A $50,000 SUV loses somewhere between $15,000 and $20,000 in its first 3 years of ownership. That is the documented average across the segment, and it happens whether you drive the car hard or barely touch it. The curve is steepest in years 1 through 3, then it flattens out. By years 4 through 7, the car loses value much more slowly. That flattened section near the bottom of the U is where smart buyers want to be. The previous owner absorbs the worst of the loss, and you step in after it is over. Depreciation is only one part of what makes a car expensive to own. The full picture is called total cost of ownership, and it adds up everything: the purchase price, the loan interest, fuel, insurance, routine maintenance, and whatever value the car has lost by the time you sell or trade it in. AAA publishes a benchmark every year. Their most recent figure says the average new car in America costs approximately $1,000 a month to own when all of those factors are counted. Not the monthly payment, the total monthly cost. Over 5 years, that comes to about $60,000. Most buyers have no idea. Now, run that framework through the lowest price range. A lot of buyers think they are being responsible when they buy a used car for $10,000. It fits the budget. The math underneath it can be worse than they expect. A $10,000 car that drops to $4,000 over 5 years has lost $6,000 of value, or $1,200 per year in depreciation alone. A $30,000 car that still sells for $25,000 after 5 years has lost $5,000 total, or $1,000 per year. The cheap car costs more per year to own, and that is before repair risk. The repair risk is not theoretical. Older cheap cars break, and when they do, the bills add up fast. Between 2024 and 2026, tariffs on imported steel and aluminum added roughly $1,200 to base model vehicles, and that cost spread into the parts market too. Routine repairs that once cost $400 now cost $550 or $600. On a $10,000 car, one bad repair can represent more than 10% of what you paid. This is the pattern the FTC has documented in studies of low-income car buyers. A single mother paid $12,000 for a used car, then got hit with thousands in dealer add-ons. She did not understand, including paint protection, documentation fees, and market adjustment surcharges buried in the contract. She lost her job 6 months later, and the car was repossessed. The cheap car became the most expensive thing she ever bought. The $20,000 to $50,000 tier is where the math starts to favor the buyer, but only if you know how to use it. A car that is 3 to 5 years old has already fallen off the steepest part of the depreciation curve. The first owner took the first year loss. You step in near the bottom of the U. You get most of the useful life of the vehicle, and you lose value at a much slower rate. Historically, this has been the most rational place to buy a car. It still is. The math just got harder after 2020. In 2022, new car leasing nearly stopped. The global chip shortage had gutted factory output, so dealers were not leasing vehicles they did not have. Leases typically run 2 to 3 years, and when they end, those cars flood the used market as certified pre-owned inventory. That is where the 3 to 5 year sweet spot supply comes from. When leasing collapsed in 2022, the supply of 2 and 3 year old used cars in 2024 and 2025 almost disappeared with it. Researchers started calling it the missing generation. The cars that should have been available at that price were simply not there. Buyers who expected a solid used vehicle for $23,000 or $24,000 found prices sitting at $30,000 or more. According to JD Power data, models that averaged $23,668 in 2020 now average $30,220 in 2025. That is a 28% increase driven not by inflation, but by a supply chain failure that happened years earlier. Buyers who did not understand this showed up to the used lot expecting one market and found a different one. Because prices in the sweet spot went up, buyers stretched their loans to reach them. 7-year auto loans became common. In 2026, the average new car transaction price in the United States exceeds $50,000. Monthly payments above $700 are routine. When you spread a car loan over 7 years, you pay interest on a depreciating asset for a very long time. By year 5 of a 7-year loan, your car is worth far less than what you still owe. Lenders call that underwater. Buyers call it being stuck. The sweet spot is still real, but today, buyers pay more to reach it and borrow longer to get there, which erodes much of the advantage. At $50,000 and above, the depreciation math changes in a way most people never see coming. A $50,000 SUV loses $15,000 to $20,000 in its first 3 years. That sounds catastrophic, and for most of the luxury segment, it is. But there is a counterintuitive exception in the data. Certain luxury models hold value at a rate that beats budget cars on a percentage basis. The Lexus RX, according to IC Cars 2025 data, retains 65% of its value after 5 years. A $15,000 sedan with weaker resale retains closer to 45%. Run the math. The Lexus buyer loses $17,500 over 5 years. The budget buyer loses $8,250. In raw dollars, the Lexus costs more to own, but the annual depreciation picture is not as simple as it looks, and at year 3, the used Lexus becomes a compelling buy. The lesson is not that luxury cars are a good deal new. They are not. The lesson is that the depreciation curve for a Lexus RX flattens after year 3 in a way many cheaper vehicles never do. A buyer who targets a 3-year-old Lexus is stepping into one of the better value positions in the used market. This is not a secret known only to wealthy buyers. It is arithmetic anyone can run. Most people are still looking at the sticker price, not the curve. Then there are electric vehicles, which have become their own price range and their own depreciation experiment. The average new EV transaction price in the United States sits around $60,000. The Federal Inflation Reduction Act offers a $7,500 tax credit on qualifying models, which requires that the vehicle be assembled in North America and that you fall within certain income limits. The credit matters, but it does not change the underlying depreciation math as much as buyers assume. What has changed dramatically is the used EV market. Buyers considering early model Teslas have run into something they did not expect: a collapse in used EV prices driven almost entirely by battery anxiety. The 2018 to 2020 Tesla Model 3, which sold new for $44,000 to $53,000, now trades for $18,000 to $22,000. That puts it below the price of many used gas compacts. Why so cheap? Buyers are afraid of battery degradation. They do not know how much range is left, what a replacement would cost, or how long the pack will last. That fear creates a discount, and for a buyer who does a little research and checks the battery health report first, that discount can be extraordinary value. The car is cheap not because it is bad, but because most buyers are scared of something they do not understand. The used EV opportunity is real, but the total cost of ownership math for EVs needs more than the tax credit. Insurance premiums on electric vehicles run meaningfully higher than on equivalent gas cars because repair costs are higher, body shops need specialized training and equipment, and replacement parts remain expensive. Depending on your zip code, your insurance rate, and your annual mileage, the fuel savings from an EV can be partially or fully erased by the insurance difference. The long-term TCO on EVs is genuinely debated. The honest answer is that it depends on your situation. What does not depend on your situation is the math framework. Run the numbers for your model, your insurer, and your driving habits. Do not assume the tax credit settles the question. So why does almost nobody walk into a dealership already running this math? Part of the answer is incentive structure. A buyer focused on the monthly payment is easy to work with. Extend the loan term, lower the payment, close the deal. The total cost grows, the dealer earns a finance commission, and the buyer drives away feeling like they won a negotiation they never actually had. No haggle dealerships, which market themselves as the transparent alternative, typically embed a markup of around 10% through algorithmic pricing. The price is fixed, but the algorithm was not set in your favor. CarMax, the largest no haggle chain in the country, runs on this model. No haggle means no negotiation. It does not mean no markup. The FTC tried to address some of the most egregious dealer practices through a rule called the CARS rule, which would have banned certain junk fees and required upfront disclosure of all charges. Dealers sued and implementation was delayed. The add-on fees that generated roughly $15 billion annually across the industry remained largely intact. None of this requires believing in a conspiracy. It simply requires understanding that the market rewards buyers who know the math and penalizes buyers who do not. The buyers who win are not cheating. They are just showing up with the right numbers. One person who showed up with the right numbers is a YouTube creator known as Car Wizard. He started buying used cars in the $10,000 to $15,000 range, doing targeted mechanical repairs and reselling them. He bought a car for $15,000, spent a few hundred on parts and labor, and sold it for $22,000. Then he filmed the process and taught 1 million viewers how the math worked. He was not exploiting a loophole. He was applying the same depreciation logic this video is built on. He found cars where the asking price was lower than the actual value, understood the repair costs, and calculated the annual cost of ownership before he ever signed a title transfer. That is the game. It is not complicated. It is just arithmetic nobody made take time to explain. So here is the framework. 5 steps you can apply to any car at any price range before you ever set foot in a dealership. Step 1. Calculate annual depreciation before you agree to anything. Take the projected resale value at year 5, subtract it from the purchase price, and divide by 5. That number tells you more about what the car will actually cost than the sticker price ever will. Step 2, separate the car decision from the financing decision. Before you go to any dealership, walk into a credit union or call your bank and get pre-approved for a loan. When the dealer wants to talk about monthly payments, you already have a number. Their finance desk has very little to offer someone who already has financing locked. Step 3, target the post-depreciation window. The 3 to 5 year ownership zone on models with strong resale history is where the math most consistently favors the buyer. iSeeCars publishes free depreciation data by make and model. Use it. Step 4, run the full total cost of ownership before you commit. That means fuel costs at your actual mileage, insurance at your actual zip code rate, the manufacturer maintenance schedule, and the full financing cost over the loan term, not the monthly payment, the total interest paid over the life of the loan. Edmunds and 8A both offer free TCO calculators. The number that comes back is the real price of the car. Step 5 for EVs. Check the insurance premium for that specific model in your zip code and verify the battery warranty before you factor in the tax credit. The credit is real, so is the insurance difference. The math only works if both numbers are included. Go back to the comparison that started all of this. A $30,000 car resells for $25,000 after 5 years. Total depreciation, $5,000. Annual depreciation, $1,000 per year. A $10,000 car drops to $4,000 after 5 years. Total depreciation, $6,000. Annual depreciation, $1,200 per year. The $30,000 car was cheaper to own per year. Most people would call the $10,000 car the safe choice if they saw both cars without the math. The math says otherwise. That is the entire game in 2 numbers. Go back to where this started. The buyer at the dealer lot, the sticker price on the window, the salesman with the iPad. That scene is going to keep happening. Dealers are not going to start handing out depreciation calculators. The market is not going to restructure itself around buyer education. But this time, the buyer running the TCO calculator does it before signing, not after. The number still climbs past $50,000. This time, they already knew it would. They bought the car anyway, or they walked away. Either way, it was a decision made with the right number. The car that costs the least to buy is almost never the car that costs the least to own. If you want to go deeper, the Edmunds total cost of ownership calculator is free and takes about 3 minutes to run on any car you are considering. iSeeCars has free depreciation rankings by make and model. Both are linked in the description. If you found this useful, the next video covers how financing terms alone can add or remove tens of thousands of dollars from the real price of any car you buy.